Hello, I'm Michael Hainsworth. For a lot of us, 2022 still bruises, at least on the fixed income portfolio side. Bonds were supposed to be that stable part of the mix. Instead, inflation surged, central banks moved aggressively, and many investors learned the hard way that low yields often are a very small cushion when rates rise quickly. But Rose Devli says that was a repricing, not a permanent impairment. Okay, I'm not saying that, you're not fun at parties, but, many advisors don't find fixed income particularly exciting. They underemphasize it, they simplify it. What's the advisor level mistake you see most?
I will say the misallocation of fixed income. 2022, what happened in that year was a repricing. It wasn't a permanent impairment. Bonds fell because you did not have a running yield. Now you do. It's very healthy. So if I were to compare what you had in 2022 to today, both times fixed income was insurance. But now you get fixed income as insurance that actually pays you to own it.
On this episode of On the Money, how investors are still fighting the last bond war, why today's yield environment is healthier than it's been in about 15 years, and why fixed income is no longer a buy and hold corner of the portfolio. But first, when we last talked about the stock market saying buy low, sell high, I pointed out that investors usually do the opposite. They buy the excitement and then they sell the fear. I urge you to remove emotion from your investing decisions. But how? Start with rules, not feelings. Rebalancing your portfolio on a schedule, not on impulse. If equities run too far, trim them. If a sell-off pushes quality assets below your target, buy in methodically. Use automatic contributions to take timing out of the equation. When markets drop 10%, your money buys more of them. It's not working against you, it's volatility working for you. Consider a watch list before the markets crack. For example, if a strong bank, utility, or broad market ETF falls on sentiment rather than fundamentals, decide in advance on the valuation or price range that would justify buying, and separate the noise from the theory. A stock is not broken because it's down, it's broken when the business case changes. So in the end, great investing is rarely about brilliance. It's more about behavior. The investor who usually wins, they're not the boldest. They're the ones with a plan strong enough to survive their own emotions. Rose, let's start with fear. When you talk to advisors and investors today, how much of the fixed income conversation is still being shaped by the trauma of 2022?
I would say, that's the elephant in the room. 2022 was a 3 in 100 event that happened to fixed income. It was basically a recipe for disaster because you had a running rate on yields at absolute lows. The 10-year US got to 50-ish basis points. And you were in a very high inflationary environment. Why was that? Because we had a virus that made federal agencies print a lot of money. In the US, it was 26% of GDP that they printed. Now, when governments print so much more than usual, it usually does lead to this lingering inflation. So if we had a central bank that started to raise interest rates in 2021 instead of 2022, the losses would be a lot less. But unfortunately, central banks were hesitant and they started raising rates. Usually they raised rates by 25 basis points, but they were raising rates by 50, 100 basis points. That's when real losses come to fixed income. Actually, if you look historically, if you have central banks raising interest rates at a moderate pace, let's say every quarter, it's actually really great for a fixed income portfolio because you reinvest your dividends at a higher rate.
Right. So we saw this sell-off tied to the sudden inflationary shock, fastest interest rate hike cycle in decades. But what do you think investors misunderstand about why bonds sold off so sharply?
I think they misunderstand the level of inflation and what inflation got to because of the environment we were in. We were coming out of a COVID crisis where there was a lot of pent up savings because everyone was working from home and different reasons. So all of a sudden, the economy reopens. There's so much liquidity out there because the government just printed 26% of GDP. So people come out of their homes and they want to spend. And we saw inflation rates in that 6, 7, 8, even 9%. Some countries even above that inflation rates, which we haven't seen. Again, that was a 3 in 100 event. In that kind of inflation environment, not many assets do well at all. That's why central banks always talk about inflation and always talk about how important it is to control inflation, because when it does get out of hand in that sort of levels, then it's hard for any asset class to do well.
You've told me in the past that investors today are being paid to be in bonds in a way that they haven't been for roughly 15 years, let alone since 2022. What does this mean in practical terms?
Yes. So everyone says to themselves, normal markets and fixed income was what we saw since the financial crisis. And I actually think that's not the case. What normal bond markets were was before the financial crisis. And that's pretty much where we are on running yields right now. And I try to remind everyone that before the financial crisis, we had these types of levels. These are what we call runny or healthy running yields.
There is, though, still a lot for investors to worry about. We've got inflation due to the U.S. war spiking crude oil, the U.S. tariffs. What don't the inflation hawks understand?
So when we talk about tariffs, when we talk about an energy shock, typically speaking, we see this as short-term inflation spikes. When you buy a 10-year bond, you're actually buying 10 years worth of return, not just 1 or 2 years. So that's why we are talking to investors and saying, this is when it's an opportunistic way of buying higher interest rates, because the market starts pricing higher interest rates and you get a higher rate of return or running yield. Typically, when you have these types of shocks, inflation does seem to come down within that 1 year mark. That's why central banks keep telling us that this is temporary or they're watching things. If they really thought this was long and sustainable, they would say indefinitely that they would be raising rates. But right now, we're not seeing that.
I don't claim to be smarter than the U.S. Federal Reserve or the Bank of Canada, but the tariff component to this feels like a long tail issue that will continue to fuel inflation.
Yeah, that's definitely an uncertainty that we deal with every day. So what have corporations been doing? They have been passing along to consumers, but not the total amount. Why is that? Well, basically, we're in sort of this questionable environment where we still see headlines where tariffs can go up and down. The most recent meetings that President Trump and President Xi has had, where we saw some headlines that said tariffs could go down. So it's not that tariffs can stick around at the rate or at this kind of, especially for China, some tariffs can be over 100%. So the market isn't necessarily thinking that it'll stay there for a long time. And that's why we also think inflation can be, a question mark going forward. Will these tariffs stay here? How long will they stay here for? And will the amount, the percentage of overall tariffs be enough to really hit the bottom line?
Rose points out that 2022 was not a normal bond market cycle. It was a rare collision of ultra-low starting yields, inflation that escaped the basket, and central banks forced into one of the fastest rate hiking cycles in decades. Now that history matters, but it doesn't mean that today's bond market is broken. It means the starting point matters. I'm going to pivot here to guaranteed investment certificates, GICs, and dividend-paying stocks. People flocked to them. And while they're not an alternative to a healthy fixed income portfolio, they do have a place, just not as a healthy part of a fixed income portfolio. A lot of investors responded to bond losses by moving into GICs. What are they getting right and what are they missing?
Listen, GICs are an excellent instrument.
You sound exasperated.
Yeah, I hate saying it. That's why. They're an excellent instrument for your cash-like percentage of your entire portfolio. When I look at portfolio management, I like it to look at things holistically, and not a lot of portfolio managers like to look at it like that. So a GIC is great when you need a certain amount of cash for a certain purchase sometime in the short-term future. The problem that we see with GICs right now is that you have Bank of Canada, for instance, has completed an aggressive cutting cycle. And we went above, basically we were at 5%, and now we're at 2.25 on the overnight rate from the Bank of Canada. Now, why is that problematic for a GIC? Well, just today I was looking at the GIC rates, and you see a cashable rate for 190, you see a 1-year rate around that 250. And for short-term inflation, that doesn't really cover things. And then not to mention is that if you have a locked up GIC, you can't really get liquidity out of that, or you get penalized for it. It's good to have that in the overall portfolio, but it definitely should not mimic or replicate the bond percentage in your portfolio. If you are investing in a GIC right now, your rollover rate, at that 2-ish%, you don't know where interest rates, longer term interest rates are going to be in a year from now. So you could potentially lose that capital gains in longer term bond yields.
I suppose it leads us to an important discussion about how investors should think about the difference between income and protection.
This is an interesting note that we try to talk about all the time. I understand. Investment advisors can get very frustrated with fixed income. I've never met someone that has been an excellent fixed income manager and an excellent equity manager. It's almost impossible to do. There's too many factors in both markets. For fixed income, for example, the yield curve. A lot of investment advisors tell me, I thought I was buying, risk of fixed income. I bought a 5-year bond. Why didn't I perform? I bought a 2-year bond. Why didn't I perform? There's different factors. Duration definitely will drive your returns in a fixed income portfolio, but the second largest factor is your yield curve. So heading into 2026, we had an aggressively steep yield curve in Canada, for example, 2s, 10s, which is basically the yield on the two-year bond, and the yields on the 10-year bond was extremely steep when you look at it historically. So if you come to me and you say, well, I bought, a short end bond fund, a 2-year bond fund, why aren't I seeing the gains? Well, it's basically because you have, again, a Bank of Canada that had completed an aggressive cutting cycle. We got down to 225, 2-year yields were just above that. And now we're in an environment where inflation could be sticky. Now, I'm not saying that inflation, we're going to see 2022 levels by any means, but it could be sticky into that, 2, 3, 3.5%. Well, in that type of environment, the Bank of Canada cannot cut interest rates. So you're stuck with a product that is in the short end of the market, and it's not going to benefit from any capital gains. And your running yield is lower than anything in the 10-year by 1%. So a lot of investors, think that they're getting adequate fixed income exposure, but the problem with fixed income, it's always changing, it's always morphing. That's why active management is so imperative at this point of the economic cycle.
If you're dealing with short-term credit, it'll give you some income, but to your point, I suppose, is those vehicles tend to be more correlated to equities than they would be to a broader basket of fixed income. So it brings me to perhaps the least sexy word in finance today when it comes to your world: ballast.
This is an extremely important point. If there's the one thing that I want, investors to take home from this podcast, is exactly that. Know what you're buying. Most clients don't know. They think that they're buying a short end credit fund and being covered for fixed income, but they don't realize that they are very highly correlated to equities, and you are buying a portion of the curve, again, that is lower because of the steepness of the yield curve. You're buying the area of the curve that is quite low right now, and credit spreads are quite tight. We're at 25-year tights on credit spreads. So it could be a little bit of problematic heading into the future if you think to yourselves, well, if interest rates are very low in the front end of the curve and credit spreads are very tight and you have positive correlation to equities, it might not be the greatest environment for those types of products. Not saying to go to zero on these types of products by any means, but to add some duration, some government bonds to add to your yield and to give you that protection if there is a stalling of growth in the future.
Right. So to extend that metaphor, the ballast in your portfolio is that fixed income component so that when the seas are rough, the ship stays on course. When the seas are smooth sailing, it's not necessarily there to help you, but, a ship in a port may be safe, but it's not going anywhere.
That's exactly it. So, for example, I talk about asymmetric risk all the time with clients. What does that mean? Well, thank goodness we have things like AI to calculate this right off the bat. But if you look at the break even, where an investor starts losing money on fixed income, if we take one security, we take a 10-year US Treasury around that 450 running yield right now. It has duration of about 8 years. So that means if interest rates head higher from here by 50 basis points, which again is 0.5%, you are still in the green because your running yield will always be your running yield. No one could take away your running yield. So your running yield is 450. You are out about just under 50 basis points. It's around 40 basis points lost if interest rates go higher by 50 basis points. However, if interest rates head lower by 50 basis points, again, very possible, you're still going to be getting a healthy running yield of 4% on US Treasuries, which is historically is still relatively high. Well, you get your running yield, so 4.5-ish on running yield, plus you get your duration boost, which is 8 years of duration times 50 basis points. So you're looking at around that 8 to 8.5% return. So I really want to hit home and say to clients that this isn't a 2022 event where you had 0 basically percent running yield. Your running yield is your cushion. Use your cushion to your advantage. We all know where equity markets are right now, and one little blip can make a growth boom, basically leave, and you'll see that interest rates and your return on fixed income could possibly be double digits because of interest rates heading lower.
I had a fan stop me in a store the other day, and we were talking about this. And I was mentioning that you and I are going to be having this conversation about bonds, and his response was, I'm not concerned about bonds. I'm not interested in bonds right now because I've got dividend stocks, and that's where I'm getting my income. And I almost had a heart attack.
That's a tough one too. I do get a lot of that in investment advisor meetings. Listen, dividends again have a purpose in your overall portfolio, but please do not put them in your fixed income portion. They're highly correlated to instruments, could be highly correlated to equities when we see a downturn in risk, because at the end of the day, dividends are not legal obligations. Fixed income debt of a corporation is a legal obligation. You are higher in what we call the capital stack. So if a corporation does go under, for example, the debt holders get paid out first before all equity holders.
And even if the company doesn't go under and things are tough, the dividend's the first thing that ends up getting cut.
Exactly. It's the easiest thing to cut. If there's no legal obligation, basically companies are paying it because they don't have other things to buy. But if they come into financial difficulty, they will 100% cut your dividend, and then you're not only your equity will be down by a certain percentage, then your dividend's gone, and it doesn't give you any sort of ballast in your portfolio if we have that habit.
There's that word ballast again. I don't want to disparage GICs. They play a role. Rose is clear about that. For short-term cash needs, they can make sense, but they're not a replacement for the bond part of your portfolio. In today's world of Taco Tuesday and volatile geopolitics, the boring 40% of your portfolio can no longer be set it and forget it. You've told us already that investors need to be active. What does active management actually mean when it comes to fixed income?
So the passive index in fixed income is structured poorly. Why is that? Well, basically, you're buying corporations in the index that like to lever up. That doesn't really make sense intuitively. And also, you're buying a duration that may not be suitable, especially for your needs. So, for example, I was talking about the financial crisis and interest rates before the financial crisis. A lot of investment advisors don't know that the duration in the passive index was about 50% lower than it is today. There's a lot of reasons, but basically the whole world was levering up. First, corporations since the financial crisis levered up from 2009 to 2020. And then governments definitely have been levering up since COVID. So we have a lot more duration risk in the index that a lot of investment advisors don't really think that they need or should need at times. And then also you have corporate exposures in the passive index that aren't ideal. You're buying corporations that are levering up. You want to be buying those corporations that are actually doing the opposite. And that's what our team looks for day in and day out. Those corporations that are being financially responsible, that are trying to pay off their debt quicker. Now, with fixed income, you have a lot of levers that investment advisors, again, aren't really aware of or just don't have the time to keep an eye on. Overall duration being your largest driver. We talked about yield curve. That's your second largest driver. Percentage of allocation to spread product or corporate credit. That's your third. And there are others as well. Now, us here at Dynamic, we try to push on every single lever that we can in fixed income. And one lever is not correlated to another. For example, the percentage of allocation to corporations changed immensely heading into Liberation Day and outside of Liberation Day in 2025. We increased our corporate credit and corporate bonds based on a VIX blowing out, and VIX, again, the volatility of equities, and equities having a drawdown. We saw the market and we said spreads are actually wider. We see value here, and we bought that. Now, another great example is on overall duration. We pulled that lever in 2000, just recently, heading into the Iran war. The US had some headlines about perhaps some faltering growth based on AI, or at least some AI worries based on January and February. And we saw 10-year rates head lower from about 420 to 390-ish. We were able to execute a large short position in duration. So we shortened the duration for our clients in the portfolio because we thought that interest rates went too low. When we saw these headlines from Iran, interest rates spiked from 390-ish to 450-ish. And we knew that that was about the area where there is some value in US 10-year treasuries, and we took off the short and went to index duration. So these are just a couple examples that we do every day here at Dynamic and the core fixed income team. And I could go over other examples in the yield curve, such that when the central bank is cutting interest rates, you really want to be in a steepener. When a central bank might increase interest rates, which could potentially be in the environment we are in Canada because our overnight rate is so low, you usually want to be in a flattener. So again, a lot of jargon we don't expect investment advisors to understand, just because they're so focused on other areas, equity, alpha, or other kinds of managing the assets they have.
We'd be remiss if we didn't talk about where you expect the Bank of Canada to be. For everyone I've spoken to, they figure that the BOC is going to be on hold for at least a year, maybe even 2 years. What do you think of that? And what's the trigger point for a change?
On the last meeting that the Bank of Canada had, it was difficult for them because in one sense they have this huge question mark on CUSMA, which is our trade agreement with the United States and Mexico. It's expiring, or I guess it could be extended on July 1st. But there's a good question mark in there because a lot of industries that are trade related are still hurting in this environment. A lot of CEOs or heads of corporations aren't quite sure where tariffs will be. On the other side of things, we saw this immense energy shock globally because of the Iran war. You know, the Bank of Canada did say if we see oil being elevated for an extended period of time, they could potentially look at interest rate hikes because that is a commodity that Canada is exposed to. We do have this resource, and it might be an engine of growth if we have oil extended high. Again, it's not my base case of them rising aggressively, but that's why the front end of the curve has been flattening. So 2 years we saw rising because the Bank of Canada did mention that there's a possibility that they raise rates if we see oil higher.
So retail investors need to understand that not all bonds respond the same way to changes in the rate. And if the Bank of Canada rate cut isn't guaranteed in this environment, how should investors be thinking about fixed income?
The consensus is you buy fixed income, you have capital appreciation because central banks are lowering interest rates. That I don't think is necessarily the case, especially in Canada. We have sticky inflation around, again, above, around that 2%, some regions above that 2% area. So in that type of environment, the Bank of Canada cannot cut interest rates when they see sticky inflation. So where should you be in fixed income if you can't rely on the normal buy, hold, and capital appreciation? Well, you should be in an active bond portfolio or active bond solution. You can't just sit anymore by the front end of the curve and be happy. Again, you shouldn't have all your resources in the back end of the curve either, because things move aggressively now. Because we have such higher absolute rates than we have for the last 15 years, you do see larger swings. Now, the difference is that our group actually loves volatility. We see the potential in alpha when you see volatility, and we're happy to execute risk based on that volatility. But people that just have bought, perhaps the index or a short-term solution for fixed income might get a little bit of a surprise at the end of the year on their returns. So I would say, really hone in on this point is you can't just buy and hold in fixed income. You have to be active. You're very busy in your day-to-day. Allow a fixed income manager that has a proven track record to outperform in this environment.
Knowing that you can't possibly know what the personal financial situation is of anybody listening to this conversation, having said that, let's talk about young Canadian, middle-aged Canadian retiree. How should that 40% of that traditional 60-40 portfolio split change depending on the investor's stage in life, based upon the volatility you are seeing today and the alpha that can be generated?
So our market is changing. How investors invest is changing. I was looking at a stat where it was a high percentage of the population is now over 50 years old, larger than it has ever been before, and the demographics are just getting worse. They're not getting better. So investment advisors, they are looking at fixed income differently. A lot of investors or investment advisors ask me or say, I'm trying to get to that 6 to 8% return for all of my clients. I need that return every year, and a portion of that 6 to 8% has to be income for those that are actually retired. And now more than ever, I tell to all investment advisors, well, fixed income can now be an excellent portion to get you to that 6 to 8% with lower volatility. That didn't necessarily happen right after the financial crisis. It was a lot, you had to take more risks. Now you don't have to take as many risks. So out of the 40% allocation of fixed income, again, depends on if you are dealing with a client that is retired versus close to retirement. Let's talk about a client that is retired. Well, if a client that is retired invests, $10 million in just fixed income, then right now they're able to get that $400,000 return. That used to be half, but right after the financial crisis. So why is this important? Well, Every market will take a downturn. Yes, equity markets are doing extremely well today. But again, there's going to be another downturn. And your retiree is still going to need that income to pay for their mortgage, rent, food, everyday necessities. Well, you don't necessarily want to be selling your equities at the bottom just to fund their retirement, the income that they need. Allow your fixed income managers, a fixed income portion of your portfolio, that 40%, to be your defensive play. Every team needs a defense. You can be your offense, but allow your fixed income team, your portfolio, to be your defensive play. So when you need the income for your client, we step up and provide that income. Again, out of that 40%, we could talk about what needs to be pure income versus ballast. I think that depends on if you're dealing with a retiree or if you're dealing with someone that's coming up to retirement. But at the end of the day, make sure that you have something to pay the bills, especially when you have a large downdraft in the S&P. And another point I wanted to just make before is a lot of investment advisors, I ask them, when the S&P is down 30%, what do you typically do? 99.9% of them always say, we add more. We buy because there's a discount. Well, I would encourage those in fixed income that look at a little bit of a bleep in your fixed income to buy more, especially if you have a lot of retirees in your client list.
Okay, I'm not saying that, you're not fun at parties, but, many advisors don't find fixed income particularly exciting. They underemphasize it, they simplify it. What's the advisor level mistake you see most?
I will say the misallocation of fixed income. 2022, what happened in that year was a repricing. It wasn't a permanent impairment. Bonds fell because you did not have a running yield. Now you do. It's very healthy. So if I were to compare what you had in 2022 to today, both times fixed income was insurance. But now you get fixed income as insurance that actually pays you to own it.
Rose, as always, great speaking with you. Thank you for your time and your insight.
Thank you, Michael, for having me.
So Rose Devli has left me with a different way to think about bonds. Not as a failed asset class because of 2022, not as the sleepy part of the portfolio either. Fixed income is insurance. But the difference today is that insurance pays. Higher yields give investors income, a cushion against rate volatility, and the potential for protection if growth slows and rates move lower. The mistake is fighting the last war. If you're gearing up for the battle ahead, you'll be on the money. I'm Michael Hainsworth. Thanks for joining us.